The year that you retire matters a lot more than many people realize. It can make or break your retirement plan. There are a lot of people now advocating for an all-equity retirement portfolio, i.e. 100% stock market for life. I think that's foolish, and I'm going to show you why. When you retire, you don't know if you're going to have bad timing or not until it's too late. So to show you what happens when you have bad timing or good timing, we're going to take a look at 6 different illustrations for someone who had retired in 1998, 99, 2000, 2001, 2, and 3. We're going to use SPY, the S&P 500 proxy ETF, as our investment for our illustrations, and we're going to use the 4% rule for our spending pattern, and we're going to analyze what happened. How did timing impact a person who retired in 1998 versus a person who retired in 2001 or 2003? Let's take a look. If you had retired on January 1, 1998 with a $1 million portfolio and SPY ETF, the S&P 500 proxy, was your sole retirement investment, like many people are advocating these days, go all equity for your retirement portfolio, and you had used the 4% rule, adjusting it for 3% inflation over time, your timing was good. Today, or rather at the end of 2024, you would have $2.1 million. All of your spending needs were met. You took out $1.6 million, and you're sitting pretty after 27 years of retirement. But if you had waited just 12 months to retire and retired on January 1 of 1999, look what a different picture emerges. Everything is the same here. SPY ETF is our investment, 4% rule, 3% inflation, $1 million starting value. But now you have $571,000 at the end of 2024. Huge difference. Timing wasn't so good if you retired in 1999. If you had retired on January 1 of the year 2000, your $1 million in SPY was completely exhausted by the end of 2023. You had really bad timing if you chose to retire on January 1 of the year 2000. Maybe someone should show this slide to the young professor who wrote the research paper Beyond the Status Quo, encouraging people to use all equity portfolios in retirement. If you had retired on January 1, 2001, your $1 million was $897,000 at the end of 2024. I would say your timing here was okay. You didn't get any inflation protection on your principal, but all of your spending needs, $1.37 million over this time period, were met. 2002 was a good year to retire. After the losses of 2000 and 2001, the return prospects for the stock market were looking much better. So for the person who retired on January 1 of 2002, they were able to participate in the long-term upside, and their ending value at the end of 2024, $2.2 million. The person who retired on January 1, 2003 nailed it. Their timing was perfect. They retired at the bottom of the stock crash of 000102, and their growth was fantastic. They now have $4.9 million at the end of 2024. Now you can see that when you retire matters. If you are lucky enough to retire at the bottom of a stock market crash after we've gone through a recession, you will have smooth sailing in retirement. When you retire and the chips are down, the return prospects for the future are very high. So if you have good timing, you have nothing to worry about. But if you have bad timing and you retire at the onset of a recession, you're going to have a tough time. You're going to struggle. And the problem with retirement timing is you won't know if your timing is bad until after the fact. What you can look at right now is that we have been in a bull market for 16 years. 2008 was 17 years ago. The bottom was in early 2009. The business cycle is real, and at some point, this market's going to turn. We will see a recession again. We've had 15 recessions in the last century. On average, we get a recession about every 7 years. You have 15% probability based on past data that a recession can happen in any given year. So think about that as you're planning your retirement. Your odds of bad timing, I think, are at least 1 in 5, maybe higher in 2025. So what can you do about this? How can you protect yourself not knowing if we're going to have a crash or not in the future? Let me show you. We already know that the year 2000 was a bad time to retire. But what if you had used asset allocation to protect yourself? For the person who retired on January 1 of the year 2000 and used a 60-40 balanced portfolio, by the end of 2024, they had $802,000. We're looking at an illustration for the 4% rule with 3% inflation for the Vanguard Balanced Index Fund Admiral Share Class. This 60-40 asset allocation survived not only the bad timing, but also the sequence of negative returns that occurred in 2000, 2001, and 2002. Then the crash in 2008. Now, you didn't get inflation protection on your principal, but unlike the person who was all equity in starting in the year 2000 with a retirement plan, this retiree did not run out of money. Big difference. This is a chart that I developed to help people easily see the long-term business cycle and how it plays out in the stock market. The red arrows are bear markets. Those are periods of time where you have no return on price for many years, over a decade. You can see that from the late 1920s to 1954, we had a 25-year period where you were losing money the entire time. If your timing was bad and you retired in 28 or 29, it took you a quarter century to break even on your investments. Obviously, it didn't work out. If you had retired in the early 60s, bad timing. You had an 18-year period where we just went sideways. And then again, as we just saw in the early 2000s, 99, 2000, bad years to retire. Where are we at today in the cycle? We've been 16 years into a bull market. The bottom was in early 2009. This business cycle is going to change. It's only a matter of when, not if. And no one knows when it's going to change precisely. You'll only know after the fact. If you are planning your retirement, there is one other critical observation that you need to take note of from this chart. Bear markets are longer than bull markets, and bear markets comprise about 60% of this graph. You will see a bear market at some point during your retirement. It's going to happen. Again, all the talk that we've seen in recent years about taking risk and having an all-equity retirement portfolio, you better have a huge appetite for risk if you are going to go into retirement with an all-equity portfolio. If you have questions about your investments, please give my office a call. We would be happy to give you a free second opinion on your portfolio. If you like this content, please share it with your friends. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.